Welcome back to another video. In this video, I will show you how to develop a trading algorithm that bases its trading decisions on fundamental factors such as the size, quality, and value of a given company. I will code this algorithm in Python inside of the QuantConnect algorithmic trading platform. The reason why we will be using QuantConnect is that you get access to all their data and backtesting capabilities for free. This is the fourth video in the series of Python trading bots, and I believe this is going to be the biggest project yet. I will do my best to explain everything to the best of my abilities. Nonetheless, I have to say that we will be using some of QuantConnect's more advanced features, such as the algorithm framework. Therefore, I highly recommend watching some of the other videos before this video if you're new to QuantConnect or Python. That said, let's start by breaking down the trading strategy that we will implement in this video on a conceptual level. Doing so will hopefully help you understand what our code is supposed to do. As I said earlier, this algorithm will base its trading decisions on a company's fundamental values. We won't be using any technical indicators for the trading decisions, but if you want to, that is definitely something you could add to potentially improve its performance. More specifically, we will rank stocks based on the company's quality, value, and size. Research has shown that historically speaking, small cap stocks seem to outperform larger cap stocks. This effect is also known as the size effect. There are multiple possible explanations for this behavior, but the most widely accepted are that smaller cap stocks tend to have worse liquidity than large cap stocks, which makes them less suitable for trading for institutional trading firms. Furthermore, small cap stocks have more potential to grow and are much more flexible. Nonetheless, it's important to note that small cap stocks can also be riskier than large cap stocks. Due to this size effect, we will give each stock a size score based on its market cap. In a similar manner, researchers also found that there exists a value effect. This effect entails that stocks with relatively high book-to-value ratios tend to outperform those with a low book value compared to their price. If you want to read more about this value and size factor, you can check out the Quantpedia entries that are linked in the description box below. Besides book value, we will also use the ratio of free cash flow to enterprise value and the most recent earnings yields when giving each stock a value score. The higher the perceived value of a stock, the more interesting we are in buying it. Last but not least, we also give each stock a so-called quality score. For this, we will use three fundamental values. Firstly, we will take the gross margin, which is the ratio of gross profits to revenue, into account. Next up, we will examine the quick ratio, which is the ratio of liquid assets to current liabilities. This is basically just a measure of liquidity. Finally, we will also look at the debt to assets ratio, which examines the percentage of the company that is financed by debt. In this ranking, companies with high margins, good liquidity, and low debt will receive a good score and thus be preferred by our algorithm. When calculating the size, value, and quality scores for each stock, we won't use the actual value of the underlying fundamental factors. Instead, we will just rank the stocks compared to each other. So for instance, having a high book-to-price ratio isn't that important as long as you have a higher ratio than other comparable stocks. Before we can actually make any trading decisions, we must first combine our size, value, and quality score in a meaningful way. For this, we will multiply each score by a given weight and then add them all up. Now, we have a combined score for each stock that we looked at. Out of these stocks, we will then buy those stocks with the best score and hold on to them unless their scores fall. Before we jump into the QuantConnect platform and start coding, let me recap the strategy one more time. Our algorithm will look at some of the most liquid stocks, and for each of these stocks it will calculate a separate size, value, and quality score. Thereafter, it will combine these scores into one total score. Based on this, the algorithm will then buy those stocks with the highest score. That said, let's now head over to QuantConnect. For the coding part of this video, I highly recommend coding along. To do so, you just quickly have to create a free QuantConnect account. There's a link in the description box below. Before we get into the actual coding though, I briefly want to note that I drew a lot of inspiration from Jack Simonson's code that he posted in his fundamental factor long-short strategy community post. So thanks for that post, Jack. Inside of the QuantConnect platform, we will head over to the Lab tab. There we can click on Create New Algorithm. This will give you an overview of modules as well as some sample code to get started. Like I said in the beginning of this video, we will be using QuantConnect's algorithm framework. More on that in a few seconds. For now, we just want to import 3 modules by clicking on them. The first module is the insight-weighted portfolio construction model. We will use this to automatically construct a portfolio for us. The second module that we will import is the immediate execution model, which automatically opens or closes trades if our algorithm sends the corresponding signals. Last but not least, we will import the maximum drawdown risk model. This model allows us to specify a percentage, and as soon as a position's loss reaches this percentage, this model will automatically manage the exit process of that position. After importing these 3 modules, it's time to click on the Create Algorithm button in the bottom right corner. This will create a sample algorithm with 2 predefined methods. The onData method is called every time the algorithm receives new data, but since we will be using the algorithm framework, we won't need this, so we can delete it. Like the name implies, the initialize method is for initializing settings, functions, and variables that we need for our algorithm. Before we start actually implementing the initialize method, I want to briefly present to you QuantConnect's algorithm framework, since this is going to be an essential tool for this algorithm. The general design pattern of more complex trading algorithms is a project that's divided into at least 5 to 6 separate modules. If you want to see a detailed breakdown of these 5 to 6 models, I highly recommend watching my Trading Algorithms Explained video. There's a link in the description box below. In this video, I will just give you a short overview of this framework. The algorithm framework consists of 5 modules. The first one is the so-called universe selection model. This is where the algorithm decides which securities it considers when looking for potential trades. Here you could consider things such as liquidity, price, industry, or whatever. For our algorithm, we will look at the most liquid securities that have fundamental data that we need available. Next up, we have the alpha model. This is probably the most important model, since this is where your edge comes into play. The alpha model's role is to send out trade signals. It does not directly send out any trade orders though. Instead, it just passes on trade recommendations to the portfolio construction model. This model then constructs an appropriate portfolio based on these trade signals. One of the simplest forms of a portfolio construction model is an equal weighted model which allocates an equal share of your portfolio capital to each position. For our algorithm, we will use an insight weighted allocation, but more on that later. Besides that, there also is a transaction cost model which models transaction costs. It does this so it can determine whether a given trade is even worth your money. If the accompanying transaction costs are too high, it might not be worth it. We won't be implementing such a model in our algorithm though. Next up is the risk model. Like the name implies, the risk model is the risk management unit of an algorithm. It decides when to take profits and when to cut losses. We will start off by using a relatively simple risk model, namely the maximum drawdown model. This model closes a position as soon as it exceeds a certain predetermined percentage drawdown. Last but not least, we have the execution model. This model's job is to send out the actual trade orders. Especially if you're opening or closing large positions, you wouldn't want to just send out one big trade order. Instead, you would want to divide your position into many smaller orders and send those at an adequate time. Determining the optimal order size and time is what the execution model is for. For our algorithm, we will just be using a very simple immediate execution model. Besides separation of concerns, a huge advantage of using such an algorithm framework is that it is incredibly easy to exchange the individual components. You can basically think of these blocks as different building parts for trading algorithms. You can easily just exchange how your portfolio is constructed or how it manages its risk simply by changing 1 or 2 lines. That is very powerful. Furthermore, QuantConnect actually offers a wide range of predefined modules. When creating our algorithm, we already imported a portfolio construction, risk, and execution model. So these 3 lines of code already take care of managing our portfolio, its risks, and trade order management. Isn't that just awesome? So all that's left to do now is to implement a universe selection model and an alpha model. We will start with the universe selection model right after we implemented the initialize method. We'll start by setting the start and end date for our backtests. It really doesn't matter which dates you choose here, I will just go with the past 8 years. Next up, we set the starting cash balance for the backtests. This is just for backtesting purposes. In real trading, this figure will be fetched from your broker platform's account balance. I will set the starting cash balance to $100,000. Next up, we set the execution model to the immediate execution model. As soon as this model receives a trade signal, it will send out an order. After that, we set the portfolio construction model to the inside-weighted portfolio construction model. This model receives allocation weights from the alpha model, it then creates a portfolio based on these weights. Thereafter, we set the risk model to the maximum drawdown model. This model takes one argument, namely the percentage loss after which it should exit a position. We will set this to 10% for now, but feel free to try out different values. Now it's time to initialize a few variables that we will use for the universe selection. To better understand this, let me quickly outline how we will implement the universe selection for this algorithm. We will add a universe using two filters, a rougher coarse filter and a fine filter. The coarse filter allows us to filter out securities based on their price, dollar volume, and whether they have fundamental data or not. Here we pick those stocks that have a price over $5, sufficient liquidity, and fundamental data. This collection of securities will then be passed on to the fine filter. Here we filter out the securities that don't have the right values for the fundamental factors that we need to score the stocks. As helper variables, we will use self.numCoarse and self.numFine. These define how many securities we look at in the coarse filter and fine filter. We initialize self.numCoarse to 200, which means that we will filter out the 200 most liquid securities that fulfill the other criteria and pass those on to the fine filter. Later on, we will then filter out the 20 stocks with the best quality, value and size scores and trade them. That's why we initialize self.numFine to 20. Next up, we initialize self.lastmonth to -1. We will later use this variable as a flag so that we can only rebalance our portfolio once a month. After that, we set the resolution of our universe to daily resolution. This means we receive daily data. QuantConnect also supports a resolution as low as minutely, but we will just use daily resolution for this video. Now, we just have to use addUniverse to add our stock universe. As arguments, we submit two methods, namely the coarse and fine filter, which we'll implement now. Let's start with the coarse filter. The first thing that we will do in the coarse filter is check if it's time to rebalance. If it isn't, we will just return an unchanged universe. Otherwise, we update the self.lastmonth flag to the current month. Then it's time to sort all the given security objects by dollar volume. But we only want to save those that have a price greater than $5 and that have fundamental data. We then save this list to the selected variable. Last but not least, we return the first 200 symbols of the selected list. This is specified by the self.numCoarse variable, which we defined earlier. This list is then passed on to the fine filter, which we will implement now. All we want to do in the fine filter is filter out those securities that have a value greater than 0 for each fundamental factor that we will use. These factors include gross margin, quick ratio, debt to assets, book value per share, cash return, earnings yield, and market cap. We filter out the non-null values because sometimes these values are set to 0 if the algorithm can't find an actual value. For a list of all fundamental factors that QuantConnect allows you to use, you can check out the linked documentation page in the description box below. Now all that's left to do in the find filter is return this filtered find list. With that, we've now successfully implemented the universe selection model for this algorithm. Let's now head back to the initialize method and start adding a few variables for the alpha model. Here we will create a couple of variables which will be some parameters for the alpha model. The first three parameters are the weights for the quality, value and size scores. As you hopefully remember, our algorithm gives each stock in our stock universe a quality, value and size score. These scores then have to be combined by multiplying each score with a weight and then summing them up. Here we define the weights for each score. I will give the quality and value scores a weight of 2 and the size score a weight of 1. Note that we will normalize these scores in the alpha model, so it's just the relationship between these weights that's important, not the actual values themselves. So 2, 2 and 1 would be the same as 0.4, 0.4 and 0.2. This weighting means that the quality and value scores have a bigger impact on the combined score than the size score. Now, all that's left to do is add the actual alpha model. This can be accomplished with self.addAlpha. Here I will submit an instance of fundamental factor alpha model as an argument. To construct this model we need to pass our parameters as the arguments. Before we can actually use this alpha model though, we have to implement it. For this, I will create a new file and call it alphamodel.py. In this file we will implement the fundamental factor alpha model class. To use this class, we have to import it in our main file with import fundamental factor alpha model from alpha model. In the alpha model file, we will import time delta from datetime since we might need this later. As fundamental factor alpha model is supposed to be an alpha model, we want to declare it as a subclass of alpha model. Just like in the main file, we will start by implementing an initialize method. However, this time we will use an actual class constructor instead of a predefined initialize method. This init constructor method is called when we initialize an instance of this class in the main method. Here we will just initialize a couple of helper variables such as self.lastmonth and self.longs, which is a list that will hold the stock symbols that we want to buy. Besides that, we also initialize self.numFine to the passed argument. We also set self.periods to time delta 31. This specifies for which time frame we want to hold each stock position. Time delta of 31 means that we want to hold each long position for at least 1 month unless the risk model tells us otherwise. Next up, we also want to initialize the quality, value and size weights. However, before we do this, we first want to normalize them so that their sum equals 1. For this, we first save the 3 values to a list and then normalize this list by dividing each value by the sum of all values in this list. After that, we can initialize the quality, value and size weights to the first, second and third element of this weights list. Now, we're already done with the initialize method, which means we can finally move on to the most interesting part of this algorithm. For this, let me quickly explain to you how the different methods of an alpha model work. First off, we have the onSecurities_changed method. This method is automatically called when a security is added or removed from our algorithm. So when the universe selection model adds new securities to its universe, this method will automatically get called. In this method, we then want to assign a score to each of those securities. Besides that, we also have the update method. This one is automatically called every time the algorithm receives new data for a subscribed symbol. So if, for instance, there's a new price data available for a given stock, the update method will be called. This is where we want to send out the actual trade signals, so that the portfolio construction model can create a portfolio out of them. We will start by implementing the onSecuritiesChanged method. The first thing we do here is create a list called added, in which we save all the added security objects. The next step is to calculate a quality, value and size score for each of these securities. We will do this in a separate method that I will call scores. We will implement that in a few seconds. First, let's understand how this scores method will be called. We want it to be able to calculate a score for quality, value and size metrics, which is why we have to keep it quite general. To accomplish this, the scores method takes two arguments. The first argument is a list of securities. This will just be the added securities list. The next parameter is a little more complex. It is a list of tuples with 3 elements each. The first element is a lambda function which maps a symbol to a fundamental value such as gross margin or market cap. And the second element of the tuple is a boolean which specifies whether we want to order the securities based on the fundamental value reverse or not reverse. For the debt to asset value, for instance, we prefer stocks that have a low value, whereas we prefer stocks with high gross margins. That's why this boolean value is true for margins but false for debt to assets. And the third element of the tuple is a number that specifies the weight of this fundamental value. For the quality score, for example, we look at the gross margin, quick ratio and debt to assets ratio. Each of these values gets its own weight. The simplest weighting would be an equal one, but you could also give certain factors more weight than others. The submitted weights will be normalized in the scores method, which is why the actual values don't matter as much as the relationship between the different weights. For the value score, for instance, we give the book value per share value a weight of 0.5 and the other two values a weight of 0.25. This means that the book value per share has twice the impact on the value ranking as the cash return or earnings yield. Before we can actually use the scores method though, we must implement it. So let's do that before we move on with the onSecuritiesChanged method. Like I just said, this method takes two arguments. First, a list of securities which is saved in the added variable and a list of tuples with 3 elements each. This list is saved into the fundamentals list. The first thing we want to do in this method is save the length of this list into a helper variable. The length of this list is the number of individual fundamental metrics that we will consider for the scoring. If the length is 0, we don't have any fundamentals to look at, which is why we then just return an empty dictionary. Otherwise, we create a couple more helper variables that we will need in this method. The scores dictionary is where we will save the scores for each symbol. Besides that, we create 2 more lists which we will need in a moment. Next up, we will normalize the weights that we submitted for each fundamental indicator. We save these normalized weights into the weights list. Thereafter, we want to create a sorted list that orders the symbols by their fundamental values. This creates a list for each fundamental value, where the first values are those with the most desired values. We save these lists in the sorted by list. Now the last step is to create and save a score for each security based on these sorted lists. For this, we iterate through an enumeration of the first list of the sorted by list. This basically just gives us an index for each symbol in this list. To calculate the score for a given security, we find out in which position of the sorted list it is. The further back it is, the worse this rank is. We then add the ranks for each fundamental factor multiplied by their weights to get the score. When we have this score, we save it to the scores dictionary. After we've done this, for every security in the added list, we return the scores dictionary. With this method, we can now easily calculate a score for a list of different fundamental factors. If we now head back to the onSecuritiesChanged method, we already have a quality, value, and size score. If you want to use different fundamental factors than the ones I used here, you can easily change them without having to change the scores method or anything else in the alpha model. To change the weighting of the individual fundamentals, you can just change the third value in the tuples of the fundamentals list. Now, all that's left to do in the onSecuritiesChanged method is combine the quality, value, and size score into one total score. We do this in a very similar manner as we already did in the scores method. First, we save an empty dictionary to the scores variable. Here we will save the total scores for each symbol. Then we iterate through the items of the quality scores dictionary. We then save the quality, value, and size score for each symbol in the quality, value, and size rank variables. Finally, we then multiply the quality rank by the quality weight, the value rank by the value weight, and the size rank by the size weight, and then add them all up. The result is then saved to the scores dictionary for each symbol. We now have a total score for each symbol. After that, we sort the scores from lowest to highest. The lower the score, the better. We then save the sorted securities from the best to worst in the sorted stock list. In the sorted symbol list, we then save the first 20 securities of the stocks with the best scores. "20" is the value which we assign to self.numFine in the initialize method in the main file. All that's left to do now is save the symbol of each of the stocks in the sorted symbol list to the self.longs list, which we'll use for our trade signals. Before we move on to the update method, however, we also want to log each symbol and its score from the longs list so that we can actually view the assigned scores in the backtest and live trading. We can do this with algorithm.log. With that, we are now done implementing the onSecuritiesChanged method. Now we just have to implement the update method and then we are pretty much done. The update method is where the actual trade signals are sent out. But we only want trade signals to be sent out once a month. That's why we first used the last month variable to test if it's time to send new trade signals. If it's time to rebalance, we update the last month variable. Then we create an empty list called insights. This is the list that will hold the actual trade signals, which are known as insight objects. The update method has to return a list of insight objects so that the portfolio construction model can construct a portfolio from them. But more on how insights work in a few moments. Before we start opening new positions, we first want to close old positions that haven't made it into the self.longs list. To accomplish this, we iterate through algorithm.portfolio.values. For each security object, we then test if it's invested and not in self.longs. If both of these conditions are fulfilled, we want to send a trade signal that tells other models that we want to close this position. To accomplish this, we will append an insight object to the insights list. For this, let me quickly outline what an insight object looks like. The standard insight object constructor takes 8 arguments, of which some have default values. The first argument is a security symbol so that other models understand for which security this insight is. The next argument is a time frame so that it's clear for which time frame this insight is valid. If nothing else is specified, the position will automatically be closed when the time has passed. We will use self.period, which was initialized to 31 days for this. Next up, we have to specify the type of insight. Most of the time you will probably want a price insight, but you could also submit an insight for other things such as volatility. Since price insights are much more common, it's also possible to create a price insight by using this method insight.price with a few arguments, but we will use the more general version here. The fourth argument is the direction of the insight. Here you can specify the predicted direction for the given security. Since we want to close any potential open positions, we will use insight_direction.flat. The next 4 arguments are optional and have a default value of none. They are the magnitude, confidence, source model, and weight of the insight. Depending on the portfolio construction model, these values can have an effect on the constructed portfolio. But since we just want to close some open positions, we won't be passing any values here. Now we have successfully closed any unwanted open positions, which means that we can now finally submit buy insights for the securities in the self.longs list. To do so, we first save the length of the self.longs list into the variable length. Thereafter, we iterate from 0 to this length. For each I, we then append a buy insight for the ith element in the long symbols list to our insight list. Once again, we will use self.period for the second argument and insight.price for the third. Since we're interested in a long position, we submit a bullish insight with direction.up. Unlike before, we do want to pass a value for the confidence and weight parameters of the insight object. For this algorithm, we don't actually need a confidence value, but if you'd go with a different portfolio construction model, it could be useful. What we do need, however, is a value for the last parameter, which is the weight of the given insight. In the initialize method of the main algorithm class, we set our portfolio model to the insight-weighted portfolio model. This model bases its portfolio allocations on the weight parameter of each submitted insight. So the larger the weight of a given insight compared to other insights, the more capital that position will receive. Since the long symbols list is sorted from best to worst score, we want to allocate more money to those securities with the best score than those with the worst score. We don't want the difference in weighting to be linear. Instead, we will use a simple quadratic equation to calculate the weight. To accomplish this, we simply subtract I from the length variable, which was defined to be the length of this long symbols list. Then we square this value. Doing so will mean that the stock with the worst score out of the long symbols list will always have a weight of 1, whereas the stock with the best score will have a weight of length squared. These values will automatically be normalized in the portfolio construction model. Now, what there's left to do is return this insights list and we're done with implementing the alpha model. Before we finally start testing this algorithm, there's one very small thing I want to add to the main file. To show you how to create custom plots, let's quickly create a method that plots the number of open positions in the portfolio. For this, we will create a method called plotting. In it, we create a custom plot by calling self.plot. This takes 3 arguments. The first is the name of the chart to plot on, the second is the name of the actual plot on this chart, and the final is the data to be plotted. To plot the number of open positions, we use the length of the list with all open positions. Now, all we have to do is schedule this method so that it's called on a regular basis. We can do this inside of the initialize method with the help of self.schedule. Self.schedule takes 3 arguments. Firstly, we have to specify on which dates we want to schedule something. The second argument specifies at which time. And the final argument tells the algorithm what you want to schedule. We want to schedule self.plotting at 10:30 AM every Monday. The exact date and time doesn't really matter, we just want it to be called once a week. Now we can finally start backtesting this algorithm. To do so, we simply have to click on the backtest button in the top right corner. Then you have to wait for the backtest to finish up. Depending on the time frame, resolution and algorithm's efficiency, this can take a few seconds, up to 20 minutes or even longer. However, this algorithm shouldn't take longer than a couple of minutes. When the backtest is finished up, a performance overview with a bunch of stats and charts will be generated. Here, it's very important to understand that these results are the results from the exact period you chose to backtest the algorithm for. Just because these results are good over a certain period does not mean that they will be good over another or in real trading. In the top right corner, you can select which chart should be displayed. The positions chart is the custom chart we created to plot the number of open positions at any given time. The other charts are automatically generated for you. Besides seeing a few general performance metrics at the top, you can also view an equity chart below that. If you scroll down further, you can also view a bunch of other metrics. One of the most interesting metrics is the Sharpe ratio. This ratio basically is a measure of risk-adjusted returns. The higher this value is, the better. I don't want to spend too much time analyzing these results, since that's not the point of this video. But if you want a more detailed breakdown of how to evaluate a trading strategy, make sure to check out my video on that topic. Besides these metrics, you can also choose to look at all the orders that the algorithm sent or view the logs of the algorithm down here. When we click on the Logs tab, we can see a list of the symbols and their scores, since this is what we logged in the unsecurities changed method of the alpha model. But now, let's head back to the algorithm. Instead of showing you the results over a specific time frame, there are a few more very useful features that I want to show you. First off, I want to demonstrate why the algorithm framework is so useful. Right now, this algorithm's risk model is the maximum drawdown model. This means it closes a position if its loss exceeds a certain amount. If we would want to change this to a trading stop risk model instead of a fixed risk model, we can easily do so by changing maximum drawdown % per security to trading stop risk management model. This tiny one-line change changes the entire risk model. Besides the trailing stop risk model, you can also choose one of the other predefined risk models or create your own. You can do the exact same thing for the portfolio construction model, execution model, or any of the others. Changes that otherwise might require restructuring your entire algorithm can now be done with one line change when using the algorithm framework. I know that the algorithm framework can be a little confusing at first. That's also why I recommend starting with classical algorithms that don't use it. But once you understand a normal algorithm, switching to the algorithm framework does certainly have its advantages. Next up, let me show you one more amazing feature that was recently added to the QuantConnect platform, namely parameter optimization. You might have noticed these yellow dotted lines in my code. These indicate the parameters of an algorithm. This indication can be turned on or off under your profile settings. A parameter is a variable such as the quality, value and size weights. Changing values such as the quality weight can have a significant impact on your algorithm's performance. Finding the right value for each parameter is a huge challenge in the quantitative trading community. Generally speaking, it's best to have relatively few parameters instead of having too many. The more parameters you have, the easier it is to overfit your algorithm to a certain dataset. That's why more dynamic models that automatically adapt usually are better than using a fixed number. To best understand parameters and how to optimize them, let's take a look at the stop risk variable. In the beginning, I set the stop risk variable to 0.1 or 10%. I never really gave you a reason why I did this, and I couldn't really give you a good reason why I chose 10% over 5%, 15% or some other value. One way to optimize a parameter is to look at a bunch of different backtests and compare the performance of the algorithm with different parameter values. Sadly, it is very hard to reliably do this if you have many parameters, since the search space becomes gigantic. Furthermore, this solution isn't perfect since it can lead to overfitting, so always be cautious when optimizing an algorithm's parameters. Let me show you how QuantConnect allows you to optimize an algorithm's parameters with the example of the stop risk parameter. First off, we need to formally define this variable to be a parameter. We can do this with self.getParameter. This method gets the value of a parameter and sets it to the stop risk variable. If, however, the getParameter can't find a value for this parameter, we still want the algorithm to work. That's why we test if stop risk is none, and if it is, we set it to a default value such as 10%. Now, we can set the parameter by adding it to the algorithm at the bottom left-hand sidebar. Here, you just have to enter stop risk, which is the name we specified in the getParameter method, and next up, we can click on the edit symbol to set it to a certain value, such as 10%. The reason why this can be useful is that it allows you to change your parameters without actually editing the source code of the algorithm. This is a great feature for testing and live trading, since you might not always want to edit the actual code. Now, we can click on the Optimize button next to the Backtest button. This opens a new tab which allows us to set optimize conditions. For now, grid search is the only optimization strategy, so that's what we will use. Next up, you can choose to maximize or minimize the Sharpe ratio, annual return, probabilistic Sharpe ratio, or drawdown. We will just go with maximizing the Sharpe ratio. Then we click on Next, which allows us to select which parameters we want to optimize for. Currently, you can only optimize 2 parameters at a time. We want to optimize the stop risk parameter. As its minimum value, we choose 1%, and as the max, we go with 25%. Furthermore, we change the step size to 1%. Optionally, you can also add some constraints for the Sharpe ratio, annual return, or drawdown down here. We won't be adding any constraints for now though. After clicking Next one more time, we can select a compute node as well as the maximum nodes allowed to use simultaneously. Note that the Optimize feature currently isn't available for free. Instead, you have to pay a few cents to dollars depending on the number of backtests and computational complexity. As you can see here, the estimated wait time for this optimization is 5 minutes and the number of backtests is 25 and the estimated cost is only about 30 cents. Let me now click on Optimize and then skip ahead to when it's finished. Welcome back. Here you can view an overview of the Optimize results page. This chart up here shows the results of the backtests with different values for the stop risk parameter. As you can see, there are significant performance differences for different values. Right below that, we can see a couple of scatter plots that can help you analyze the relationship between values of the parameters and some other performance metrics. If we scroll down to the bottom of this page, we can see a more detailed breakdown of each backtest. Here we can sort the backtest by probabilistic Sharpe ratio, net profit, drawdown, and the actual parameter values. I will sort them from best to worst Sharpe ratio. Here, 10% actually is the best value with a Sharpe ratio of 0.512 and a net profit of over 97% over this time frame. 12% seems to be the next best value and then 5%. Note that if we look at net profit instead of Sharpe ratio, 12% actually is the best value. Similarly, the best parameter values change if you sort the backtests by other metrics. For instance, a stop risk value of 1% yields the lowest drawdown of 27%, which makes sense since it's a very tight stop loss. However, a stop risk value of only 1% also only generates a net return of under 50%, which means that the Sharpe ratio of that backtest is actually one of the worst. Note that this is with the trailing stop risk model and not with the maximum drawdown risk model. Besides the metrics displayed here, you can also click on columns to select other performance metrics to look at and sort by. Besides that, you can also filter the backtests by other criteria in the Filter tab. This can be especially useful if you're analyzing hundreds or even thousands of backtests at the same time. But note that if you look at different timeframes or change some other parameter values, 10% might not actually be the optimal value anymore. For a more detailed view of each of the backtests, you can click on the backtest name. This will bring you to a standard backtest view of the selected backtest. Besides the stop risk parameter, it is also possible to use this optimize feature for other parameters such as the quality, value and size weights. Just make sure not to over-optimize your algorithms to the available backtest data. Better backtest results don't always lead to better real-world performance. Speaking of live trading, I usually get a bunch of questions regarding how to live trade your algorithms, so let me quickly show you how to trade an algorithm live through QuantConnect. To do so, you just have to click on the Go Live button next to the Optimize button. This will then allow you to select from the currently supported broker platforms through which QuantConnect allows you to trade. Currently, interactive brokers probably is the most popular choice, but hopefully more brokers will be added in the future. If you just want to test your algorithm by paper trading it, you can also do so by selecting paper trading here. Note that live trading an algorithm requires you to always have a server node up so that it is always ready to communicate with the connected broker. That's why you need an upgraded account to live trade through QuantConnect. The cost of this starts at about $30 a month, which in my opinion is a fair price. That said, I would not necessarily recommend trading this algorithm live. The goal of this video and algorithm was to show you how to start developing your own trading algorithms. I'm not claiming that this is a particularly good trading algorithm. Some problems of the algorithm include high correlation to the market, possible overfitting, transaction costs, many parameters, and more. If you want to practice your algorithm development skills, you could use this project as a base and add your own alterations, improvements, and experiments to it. Possible exercises include exchanging some parameters with more dynamic models, trying out other weightings, including the actual stock scores as insight weights for the portfolio construction, improving the scoring system, implementing some of the other models yourself, or even adding other components to the alpha model, such as a momentum technical based factor. I left a link in the description box that allows you to clone the entire code from this video. If you liked this video, I highly recommend checking out some of my other videos inside of my algorithmic trading playlist. That said, definitely make sure to smash the like button, subscribe, and turn on the notification bell for more content like this. Thanks for watching.